Welcome back to The Explainer. This is where we take all that dense, complicated stock market analysis and turn it into a super clear visual roadmap so you know exactly what the market is actually doing. Today, we're tearing apart the latest chart data, and we're looking at a huge dynamic playing out right now. It's this constant, ongoing battle between aggressive momentum and healthy digestion. Let's get right into it.
So imagine you're looking at your portfolio and you see a stock just dropped almost 5% in a single day. Your first instinct? Probably to hit the panic button, right? Well, what if I told you that a sudden, sharp drop like that doesn't automatically mean the stock is turning bearish? Actually, depending on the trading volume and the broader pattern, it might be literally the exact thing it needs to fuel its next massive run. Here's our roadmap for today's explainer. We're going to start with Tesla's heavyweight technical setup. Then we'll take the pulse of the broader market, look at a few stocks that are digesting some massive recent gains, and finally, we'll wrap up with exactly how to handle incredibly overextended tech names. So you don't get burned. Section 1. Tesla's crucial technical setup. If you've been watching Tesla lately, you know it's been on an absolutely wild ride. The source analysis actually points to a classic technical pattern here called a bullish pennant. Basically, after a crazy rocket ship run upward, the stock starts making lower highs and higher lows on the daily chart. It's tightening up. The momentum is just taking a little breather, effectively forming that pennant shape. It's really just re-energizing the battery after a massive push. Let's look at the exact numbers here. Tesla dropped 4.6%, bringing it down to around $416 a share. But look, here's why it is absolutely not time to panic. As the price dropped, the trading volume actually went down too. In technical analysis, pulling back on lower volume is an incredibly healthy sign. The critical zone you want to watch is that $413 to $415 range, because that lines up perfectly with the 61.8% Fibonacci retracement level. As long as it holds that specific support, it's literally just refueling. But keep a close eye out for this warning sign. We start closing nicely below 410, well, that daily trend line breaks and bullish momentum heavily stalls out. Now, when we zoom out to the weekly level, things get even more fascinating. Tesla's actually forming a massive rising triangle. It keeps hitting equal highs and getting rejected, but every single time it pulls back, it makes a higher low. Historically speaking, this is a pattern that builds up immense coiled spring pressure that leads to some truly spectacular breakouts. So the crucial point is this step-by-step path. For the traders out there who are looking for that action trigger, you are waiting for Tesla to snap that daily and 1-hour upper trend line. If it breaks above that, the analysis points to a really rapid progression. We're talking a quick retest of the low 450s, filling the price gap around 475, and ultimately challenging those previous all-time highs in the 480s as we get closer to the SpaceX IPO. Moving right along to Section 2, the broader market pulse. Before we get too hyped up about individual stocks, we really have to look at the broader market context, with the S&P 500 tracked by the SPY and the volatility index, the VIX. So the SPY reached $760.28. It missed a major target of $761 by literal pennies. After an incredible winning streak like this, the analysis emphasizes a really simple truth. You just cannot look at this SPY data and call it bearish. There's absolutely nothing bearish about it. Even if we see a perfectly healthy 1 to 3% pullback to form a higher low, or even just some sideways chop while the moving averages catch up, the broader trend is undeniably strongly bullish. Meanwhile, the VIX, the market's fear gauge, actually popped 5% while the market was totally green. It's definitely showing a little bit of life. The data suggests it could pop a bit higher, maybe toward the 17 level, but what you really want to watch for is a solid rejection back down to the 14s. That drop back down, that's going to be your ultimate signal that bullish momentum is fully resuming across the board. Section 3. Digesting massive recent gains. All right, let's talk about stocks that just experienced explosive growth and desperately need a moment to breathe. We call this digestion. I absolutely love this metaphor from the source material regarding Robinhood, ticker symbol HOOD. It just had this massive 25% run from its lows to its highs in just 2 days. As the analysis perfectly puts it, it just went to an all-you-can-eat buffet and ate everything it wanted to eat in 10 minutes. Now, you gotta let it sit down. Stocks have to digest their massive gains, just like we have to digest a massive meal. So expect some sideways chop and consolidation here. The source data lays out this brilliant if-then logic for these momentum stocks. For HOOD, if it holds support in the $80 to $85 range and digests, a break above that $95 trend line targets 100 to 105. For SOFI, you just want to let the 9-day exponential moving average catch up and then watch for a break of the low 19s.
And for Palantir, ticker PLTR, which is currently rejecting at the 161 to 162 resistance, you're looking for a healthy pullback to the 150 to 155 support area. If these stocks hold their digestion support levels and then break those action triggers, that is exactly when the next massive run begins.
Finally, Section 4, Navigating Overextended Tech Stocks.
Let's transition over to the danger zone and look at some tech stocks that are flying a little too close to the sun. This is where risk management becomes your absolute best friend. Take CoreWeave, ticker CRW. Following some highly positive weekend news, it completely gapped up at the open. It literally gave traders zero chance to enter on a nice little pullback. But the chart analysis is crystal clear here. Chasing a gap up like this is incredibly high risk. Look, sometimes breakouts leave you in the dust, and honestly, that's okay. You have to be patient. Wait for a retest of the 115 to 120 support zone before you even think about looking for an entry.
The real risk becomes incredibly apparent when we look at ServiceNow, ticker NOW. After an absolutely crazy move upward, the stock price pushed a staggering 17% above its 9-day exponential moving average on the daily level. And as the source analysis clearly warns us, buying into a setup this overextended is simply terrible risk management. I mean, can it go higher? Sure. Anything can happen in the market. But if you take trades that are 17% extended above the moving average 100 times over, your win rate is going to be awful, and you'll just be sitting in massive drawdowns for a really long time. So how do we actually build this into an actionable strategy? Well, the source provides an A+ playbook for dealing with these high flyers. Step 1, wait for a pullback to major support. For ServiceNow, that means down to the 115 to 125 range. Step 2, let those moving averages physically catch up to the price. Step 3, watch for that pullback to happen on low volume, rounding off at the bottom. And Step 4, make your move and buy the subsequent rip upward. That right there is exactly how you trade momentum without taking on disastrous risk.
We have covered a ton of ground today, right? From Tesla's massive coiled spring rising triangle to the extreme patience required for these overextended tech flyers. With the market constantly shifting back and forth between aggressive momentum and vital digestion, the big question for you right now is, which of these exact setups are you keeping a close eye on tomorrow? Thanks for joining me on The Explainer, and keep studying those charts.